Benjamin Franklin famously wrote, "In this world, nothing is said to be certain except death and taxes." But in the United States, a person's tax obligation doesn't end merely because life ends. So what exactly is your, or more accurately your representative's, tax obligation after your death? I'm the Tax Geek, and here is Death and Taxes, oversimplified. From the very first time you bought something as a child and found out that a $1 item actually costs $1.08, you've been paying taxes. You continue to pay all sorts of taxes throughout your life, and you might think your tax obligation ends when you eventually die. Unfortunately, it often doesn't. Depending on the circumstances, your representative might have to file a personal tax return for the year you died, an estate income tax return, or if your estate is particularly large, an estate tax return. There can be a lot of confusion between the estate income tax return, which is filed on Form 1041, and an estate tax return, which is filed on Form 706. The estate tax is a tax levied on the value of the estate's assets. Currently, the estate tax only applies to estates with a value of over $12,920,000. The estate income tax return, in contrast, reports any income your estate receives between the date of your death and the date your estate is settled. If this income exceeds $600 in a calendar year, this return must be filed. This video will concentrate on a decedent's final tax return and the estate income tax return. The estate tax is a complex subject that most people will never have to deal with. If you think you might have a large enough estate to trigger estate tax, your best bet is to consult with a professional estate planner or attorney. Let's take a look at the final tax return. Your representative has to file a final tax return if your income exceeded the filing threshold for the year of your death. The filing thresholds for 2023 are shown on the screen. Even if your income didn't exceed these thresholds, it may still be advisable for your representative to file a tax return if there are withholdings or refundable tax credits, such as the earned income credit, that could generate a refund. For the estate's representative to claim a refund, a Form 1310 has to be filed. This certifies that any refund due will be distributed to the heirs according to the will or state intestacy laws. On a final tax return, the standard deduction may be claimed in full, regardless of when the taxpayer died. If the death was fairly early in the year, this can substantially reduce or even eliminate the decedent's tax liability for the year of death. If your spouse dies, you are still considered to be married to your spouse as of the last day of the year, unless you remarry. Thus, you can claim the advantage of the full standard deduction for the married filing jointly filing status, again which has the potential of lowering or eliminating any tax liability. If you remarry before the end of the year, you must file either jointly or separately with your new spouse with your income. The return for your deceased spouse, if it need be filed, is filed as married filing separately using only his income. Now let's look at the estate income tax return, or Form 1041. Upon your death, an estate will be created. Depending on the circumstances, it might take months or even years to pay the final expenses of the estate and distribute the estate to your heirs. During that time, the estate itself might have income. Bank accounts may accrue interest, and investment accounts dividends. There may be an ongoing business or rental properties generating income, and investments or other property might be sold, generating capital gains. If this income exceeds $600 for a given year, a Form 1041 must be filed. To file a 1041, the estate must be assigned an employer identification number. This is very easy to obtain by going to www.irs.gov and choosing Apply for an Employer ID number. This number is then used for all financial matters relating to the estate, not the least of which are taxes. The top part of Form 1041 contains the name of the estate and the name and address of the fiduciary, which is the personal representative or executor of the estate. Since a 1041 can be filed for a number of different types of trusts and estates, decedent's estate is checked in Box A, and the taxpayer's date of death is entered in Box D. Box B shows the number of K1s attached to the return, if any. If this is either the initial or final return for the estate, the appropriate box is checked in Box F. Since many estates are resolved within a single year, oftentimes both the initial return and final return boxes will be checked. All the estate's income will be listed in the income section. If the income requires a separate schedule, such as business income, capital gains, rental income, or farming income, those schedules must be filed with the return, much as with a Form 1040. In the deduction section, we're most interested in these deductions. The same deduction for interest and taxes may be taken on the 1041 as on Schedule A, Form 1040. Only interest and taxes paid by the estate are deductible on Form 1041. Interest and taxes paid by the decedent before death are reported on the final 1040. Fees paid to the fiduciary or representative, attorneys, accountants, and tax preparers, plus certain other administrative expenses incurred by the estate are deducted on lines 12, 14, and 15A. Now there are two choices with regard to the estate's net income. The estate can retain it and pay taxes on it, or the estate can distribute the income to the heirs according to either the will or that state's intestacy laws. If at all possible, it's almost always better for the income to be distributed because income tax rates for estates are usually much higher than individual income tax rates for the same income. The amount of income to be distributed is the income distribution deduction, which is calculated in Schedule B of Form 1041. A Schedule K1 is then prepared for each heir, again according to the terms of the will or state intestacy laws. If the estate instead chooses to pay the tax on its net income, the tax is computed in the tax and payment section. Just like an ordinary Form 1040, if any prepayments were made, they are subtracted from the tax liability, resulting in a balance due or refund. A Form 1041 must be filed by the regular tax deadline of April 15th or thereabouts. If you require an extension, Form 7004 is used to obtain an automatic 6-month extension. This is merely a brief outline of how death affects taxes. Proper estate planning with an eye towards reducing tax liability is a complex subject that is best left to qualified professionals. But if you'd like additional details, you'll find additional resources and information in the video description. Please like the video if you found it informative and share it with anyone else who would find it useful. Subscribe if you haven't already for additional oversimplifications of our complex tax system. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.